Hello friends. Welcome back to Reading Mindset. Today we will talk about a book, The Intelligent Investor, written by Benjamin Graham, which was first published in 1949. Graham was an American economist and professional investor. Graham is considered the first ever value investor. Warren Buffett, who is a very famous investor, credits Graham with teaching him the investment framework and considers him the most influential person after his father. With the help of arguments, examples, and practical principles, the intelligent investor has, toward the investment decisions of the readers, created a mental and emotional attitude. You will get to know that with minimal effort and capability, you can also get better results. If you haven't yet subscribed to our channel, then before you are lost in the video, immediately subscribe to the channel, and also like the video immediately. By joining our channel, you can get benefits of live book workshops. Our channel is one of the best summary channels on YouTube. Our videos can sometimes be a little longer, because we never compromise on the content of the video and book. Therefore it's important to watch the video until the end. One more book, Launch, written by Jeff Walker. In this book, a product launch formula is given. A famous board game, Wildcraft, an herbal adventure game, even after a bad start, was sold using the online product launch formula. This story was recently released by Money Epiphany channel. The video link is given in the description. You can watch the video and subscribe and support the Money Epiphany channel. The main objective of the intelligent investor is to give information on a successful investment policy to a common person, and executing it successfully. Those who invest in the market every day, this book isn't for them. Nor is its objective to teach you to beat the market. This book can help those a lot who want to learn about investing from the beginning. This book is divided into 3 different parts. First, who is an intelligent investor, and after that, defensive and enterprising investors, that is, aggressive investors, are explained in detail. So let's begin. Who is an intelligent investor? Let's start with the most important question. Why invest? Because of inflation. This destroys our wealth by almost 3% a year, and it's very easy to observe this. When the inflation rate increases, then people depending on a fixed income will suffer a lot almost every year. On the other hand, those who invest regularly, even during inflation, get support from dividends and investment portfolio value. So what does Graham mean by intelligent investor? It simply means staying calm and disciplined, and being eager to learn. You should control your emotions and think about yourself. No matter how careful you are, your investment value will drop from time to time. You cannot remove this risk, you can only manage it and control your fears. In other words, the biggest problem and enemy of investors are themselves. Therefore, you have to emphasize 3 things: how to reduce unrecoverable loss, how to increase sustainable gains, how to control self-defeating behavior that doesn't let most investors reach their full potential. The first principle an intelligent investor has to learn is that an increase in stock price increases the risk, and a decrease in stock price decreases the risk. An intelligent investor is afraid when the market goes up, because due to high prices, it's difficult to buy the stock. While you should welcome a downward market, because now the stocks can be bought again. Here the margin of safety concept of Graham hits. By not putting too much money into an investment, your risk of wealth destruction can be reduced. It's important to notice that Graham has used the word investor with speculator too. Those who invest earn for themselves, and those who speculate earn for their brokers. Investment gives right returns with safety. An action that doesn't fulfill this requirement is like speculation only. We will talk about 2 types of investors next. The defensive investor, also known as a passive investor. They avoid big mistakes and losses, and focus on freedom from continuous effort, trouble, and the need to make decisions. The enterprising investor, also known as an active or aggressive investor. They like to use their time and focus to select securities, which are more attractive than average. Also, their average returns are more than passive investors. It's wise to buy high-grade bonds, as is buying different types of leading common stocks that any investor can do with minimal or no help from experts. Let's understand in detail these two types of intelligent investors. The defensive investor. A defensive investor, even while sitting still, runs a race and also wins. Don't buy more because the stock market has gone up, and don't sell when it's down. In Graham's approach, we have to replace guesswork with discipline. 50% bonds and 50% common stock is a good approach. Any change depends on your attitude, risk appetite, and life circumstances. If you can take more risk, then go into bonds or cash for a minimum of 25%. If you can't take risk, then aim for at least 75% in bonds or cash. Change these percentages only based on your life circumstances. Every 6 months, balance them on easy-to-remember dates. Bonds. Bonds have low returns, and they are secure and stable. Therefore, it's wise to stay away from low-quality and high-profit bonds. Mostly, the bonds that investors focus on are savings bonds. Bonds, along with monthly income, offer cheap and good diversity, which, without any commission, you can reinvest immediately at the current rate. For most investors, bond funds are better than individual bonds. Many firms offer many options of bond funds at a low cost. Common stocks. You can be left without high-quality common stocks in your portfolio, because they protect against inflation, and also give more returns in the coming years. Graham's rules for common stocks: have common stocks in a right limit, but not overly diversified. At least 10 and at most 30. Limit yourself to companies with strong financial conditions, and that have long records of dividend payments. Limit your price for a new issue. Around 25 times their average earnings of the past 7 years. Not more than 20 times the last year. This strategy eliminates the strongest and most popular companies too, also all the categories of growth stocks. A quick explanation for Rule 3, benefits of your portfolio can be lost if you pay a high price for your share. Relatively, big and popular companies are a good option. Read financial statements of any company, and don't invest in it without estimating its business value. For a defensive investor, mutual funds are a good option to get the upside of stock ownership, without any downside, where you regularly have to monitor your portfolio. Here, at a low cost, you can get good diversification and convenience. In this case, to select your stock, you are taking help from a professional. Whether the market goes up or down, you can buy more every week, month, or quarter. Index funds. The best way is to have a portfolio of index funds. Index funds have all the right stocks and bonds. This way, you can avoid guessing where the market is going. Practically, assume that you can save $5,000 per month. By having just 3 index funds, $3,000 in the stock market, $1,000 where foreign stocks are held, and $1,000 in bonds. This way, you are holding almost every investment on this planet that is beneficial to have. Every month you buy more. If the market falls, your already set amount goes further, and you buy more shares than the previous month. If the market goes up, your money buys fewer shares. By having your portfolio on autopilot mode, you avoid losing money in a rising market, which is more dangerous because buying is costly, and refuse to buy in a falling market, which makes investment cheaper but increases the risk. On the performance of an index fund portfolio, expecting a 7% average return, which costs 0.3% of the portfolio's value. You should expect 6.7% average returns per year. For low-maintenance stock investing, low-cost index funds are the best tools. No matter how much a good defensive investor justifies, it takes much more effort to make it better, because here the risk is high and the cost is more. Hold an index fund for 20 years. Add money to it every month, and you can be professional and individual investors in it. Graham and Warren Buffett both praise index funds a lot. Even during the worst times of the market, some defensive investors enjoy the risk of diversification and selecting individual stocks. This is the power of disciplined buying. In this case, keep 90% of your stock money in index funds. Pick your own stocks and 10%. Never involve your speculative thinking in investing, and don't mix your speculative account's money with your investing account's money. The enterprising investor. Aggressive investors also start with the same base as defensive investors. And if intelligent analysis proves it right, then they buy other types of securities too. Remember, in an investment program, if you use extra knowledge and cleverness, then you will ruin it rather than get better results. Graham gives some points that aggressive investors should never do. High profit bonds. Foreign bonds. If you can take more risk, then these will seem more appealing. Day trading, where you hold a stock for a few hours. The more you trade, the less you will be able to hold. Rather, an enterprising investor should focus on buying in low markets and selling in high markets. A good company is not a good investment if you pay too much for a stock. Carefully chosen growth stocks. Don't focus on the growth of the stock when they are going best, but when something goes wrong. Various bargain issues. Temporary unpopularity creates wealth, which allows you to buy a good company at a good price. Some investors may be experts in selecting their stocks. The rest should take help, especially from index funds. If you pay attention, Graham advises investors to practice first. Start by spending a year tracking and picking a stock, but not with real money. Test driving in your own way before investing real money. You can make mistakes without bearing real losses. Have discipline and avoid trading. Compare your ways with leading money managers, and learn what is working for you. If you don't enjoy experiments, and your chosen options are poor, then you won't be harmed either. Take an index fund for yourself, and avoid wasting your time in stock picking. If you enjoyed experiments and earn good returns, make a basket of stocks gradually, but keep it limited to 10% of your portfolio. Keep the rest in an index fund. And remember that if you are not interested, and returns are bad, then stop. A last note to become an aggressive investor. Ultimately, financial risk doesn't depend on how your investment is, rather on what type of investor you are. Risk is inside you. If you want to know what risk is, step up to a mirror. That is risk, that you can see in a mirror. Successful investment is to manage the risk, not to avoid it. So friends, we invest because of inflation, which erodes our wealth. An intelligent investor is ready for discipline and learning, controls their emotions, and manages their fear and risk. As soon as the stock price increases, they become more risky, and they are less risky when the price falls. When you avoid paying too much for an investment, you reduce the chances of losing your wealth. For a defensive investor, a 50% bonds and 50% common stocks approach is good. Hold an index fund for 20 or more years. Add money to it every month, and you will perform better. Thank you, friends. I hope you liked the video. I hope you could understand some details of the intelligent investor. If you haven't subscribed to our channel yet, then immediately subscribe to the channel, and also comment on the video. This increases our motivation consistently. By joining our channel, you can also take benefits of live book workshops. Jeff Walker's launch books link is given in the description. You can watch the video, subscribe, and support the Money Epiphany channel too. Follow us on our Instagram, Facebook, and Telegram, and if you want to collaborate with us, then email us immediately. If you think this video can help others too, then share it with others too. We'll be back soon with even better videos. Thank you so much.